The broadcast is now starting. All attendees are in listen-only mode.
How do you do, ladies and gentlemen? I'm your host, Seth Julian. We're going to be starting in 30 seconds. So stay tuned, and we will launch our session in 21 seconds. In advance, however, if you could mention in the question and answer chat area whether you hear my voice and see the screen, we'll be able to assure that everybody's online. So please just indicate whether you can hear my voice and see the opening screen, and we'll begin now. How do you do, ladies and gentlemen? My name is Seth Julian. I'm the capital markets analyst here at Bankso Trading, and I want to welcome you to today's session where we're going to ask the basic question: what is technical analysis? And by the way, let me just introduce myself. I'm ahead of myself. As I mentioned, my name is Seth Julian. I'm 66 years old. I've been trading the capital markets for approximately 53 years. I started my career in Wall Street in the 1980s, working with an outfit called Bankers Trust Company, and I have been working with a number of international brokerages since then, and currently am a member of the Bankso community. And with that, and I have advanced degrees in finance and economics and management. So I have a lot of experience and training in the field. If I can ask again for those of you who can't, I hope you can hear me and see please mention in the question and answer, in the question area that you hear, hello, something to let me know that we're online for fun and set up and I'm not just broadcasting into the ether. So I appreciate that. We have a number of people in the room. Just a response from one or two will be fine. In the meantime, I don't see anybody responding, so I'm a little bit concerned. My system says sounds going out, but I do need a little bit of reinforcement to let me know that you're out there and hearing and all systems are good. So please respond in the question area. Hello, all systems are go, something to that effect. I'll wait for somebody to respond, please. Yep, looks like all systems are go on my end. And yet I see no response. Okay, no, we're on air, and yet nobody is responding. Ladies and gentlemen, I do ask that you put in some indicator that you're in attendance. Please, if I can ask some of the attendees that I'm familiar with, Johan, if you would just say hello and let me know that you're hearing, I would appreciate that. That way that we can get underway formally. Please, please mention whether you can, or Gideon, anybody just please, okay, I guess I'll take those hands up as good enough. Rather than typing, I'll take that as you're in. I hope, I could be wrong. Gideon, Johan, nothing in the question answer area. Maybe the chat, perhaps, you're filling stuff in? No, nothing in the chat. All right, I'm gonna get underway and hope for the best. So here we go, ladies and gentlemen. What is technical trading? Technical analysis. Technical analysis is a fancy term for price action or price movement. Price action itself is a jargon term for price movement. This is price movement. The asset in question is crude oil, and we're looking at a daily chart. This is obvious from right there, the watermark. It's a CL1. That's the indicator for crude oil. It gives you the full title, and it gives you the designation. Now, let me point out, I actually wanted to hide this. I didn't really want to see this. COT, we can hide that as well. Okay, because I wanted to give you a clean chart as we develop and illustrate some of the tools. Now then, all this is these candlesticks, which is what these time intervals are called. This is how many of us represent price movement on a chart with a device called candlesticks. And these are uh, transfers from the Tokyo rice market. They were brought to the West by a guy named Nissen in the 1970s, Steve Nissen. And what they show for each bar is the same thing that all capital markets present to all of the people that buy their data. The opening price at the beginning of the interval, the high price reached during the interval, the low price reached during the interval, and the price at the close of the interval. All that information, I'll make this bigger so you can see, is contained in the bar. So if we just take one at random, we see price opened here and closed there. How do I know that? Because it's marked red. So therefore I know that it closed below the open. What are these little tails on the candlesticks, or wicks as they're referred to? If it opened here, the price actually went higher than in the open, declined a little bit and went down here, and then closed above its lowest point. Oh, here's a better example of that. So it climbed above the open, signified by that wick. It went down below where it closed. So this is the body of the candlestick is the open and the close. The wicks outside of that body comprise the high and the low. Is that clear to everyone, ladies and gentlemen? Shall I review that? Do you need any time to take notes? Please respond. I'm a little concerned that we've got no two-way communication here. Just some sign of life in the question areas. There we go. Guidon. We are okay, he says. Thank you, sir. I appreciate that very much. I am calm now. All right. Now, all capital markets report open, high, low, close per interval. Now, in this model, each interval represents one day. Ladies and gentlemen, I'm going to show you the single most powerful tool you have when it comes to analyzing price movement, and that is this feature, the time interval. Dr. Alex Elder instructs us that a confirmation of a trend in three associated time intervals, in other words, if I'm looking at a daily chart, then I want to go down to, say, a 4-hour chart in a shorter range, and say a 1-week chart in a larger range. I'll show you how this works. Will confirm a trend. A trend is relevant to the time period. So if I compress this, we see that oil's been moving in a fairly fixed range for a while now. But if drill down to a 4-hour chart, I may not see that same pattern. Although here I do, largely the same. If I go up to a 1-week chart, I actually, interestingly enough, see a similar trend. So in the weekly charts and the daily charts and the 4-hour charts, I see a similar trend. That is crucial, and this is the singular most important tool you have when analyzing prices on a chart. The second most powerful tool is called volume. Now, I had mentioned that all markets report out open, high, low, close, and many of them, but not all, will also report out the volume. The volume is the amount of trade that took place during the time interval. And this is a crucial statistic that's reported out by these markets. Keep in mind, none of these are yet indicators. These are just the raw output that all capital markets produce. So we have the open, high, low, close during the interval, as well as the volume that occurred during the interval. Anybody know what the definition of volume is, ladies and gentlemen? Volume. You need to know this because it's important to understand the movement on the price charts. Volume is the amount of trade that took place during the interval. And so we see that this, by the way, is simply a moving average, an exponential moving average applied to the volume. That's all this is. And here is the general understanding of the relationship between volume and movement. If there is a great deal of volume that occurs during a price movement, that indicates what we call sentiment, or what a physicist would refer to as momentum, that these prices are moving with force behind them. And that force is what's driving the price in the direction it's moving, up or down, and vice versa. When there is lower volume, as we see on this ascent, significantly below average volume, that indicates that there's not too much sentiment behind this move. It's weak, and therefore, and you can see further signals of the weakness. See those long tails? Price moved radically and yet closed almost exactly where it opened. That indicates a battle between the bulls and the bears, the buyers and the sellers. Remember, what causes a buyer to go up or down? If there are more buyers than sellers, the price rises. If there are more sellers than buyers, the price falls. That's all there is to it. So you shouldn't think that this is particularly complicated. It's not. And let me further say something that many, particularly newbies, are unaware of, or just unaware of. These charts can look highly scientific and highly deterministic. They look like, here, I'll show you this layout here. We see this from MT5, which I use. These are 1 minute charts of the major trading currencies to the dollar: Aussie dollar, euro dollar, pound dollar, dollar yen, dollar Swiss, dollar CAD. And this fantastic opportunity that lasted precisely 3 minutes was the recent consumer price index release in the United States that showed inflation is still alive and well. It's not robust, but it ain't dead. And therefore, the dollar strengthened because it was understood by the markets at the time that interest rates were not likely to be falling anytime soon because inflation is still on the run. And therefore, the markets reacted negatively. The stock markets fell and the currency strengthened. That's the whole long and the short of this trade. But I want you to understand that all these bars represent are a graphic representation of human emotion that attaches to these assets. No asset has an absolute price. Take gold, oil, what have you. None of it has an absolute price. It's relative to something else. And that relative value shows what the emotionality is. So if the dollar is seen to be getting stronger, as this chart represents, the Australian dollar in the Aussie dollar pair weakens. It weakens against something, it strengthens against something else. Even if you take oil, oil isn't an absolute thing. It's oil versus the dollar. 1 barrel of crude oil, which is exactly 42 gallons, is priced in dollars. If human emotion, if the emotion of the trading crowd is less favorable toward oil, they sell it off and the price falls, and vice versa. If the emotional connection to oil is stronger, they buy more and the price goes up. And that is all that is symbolized in these candlesticks. You can see the average price is rising, and there's emotion behind this. It's solid until here, and then it drops off. Notice that the volume is lower on the decline than it was on the ascent. That indicates to many traders that the decline is less valid and therefore likely to reverse, and it's already starting to reverse. Is this point clear, ladies and gentlemen? The relationship between price and volume. I hope so. You're a quiet crowd today. I don't see a lot of response, but I do know that you're out there and listening and hopefully taking notes. What I want to tell you, this is particularly enlightening, I hope, enlightening for the newcomers, people who aren't that experienced. There is a tendency to believe that the more technical indicators you apply to a graph, the more likely you are to have successful trades. This, ladies and gentlemen, is idiotic. It's wrong, and it's the opposite of the truth. We have a concept in statistics called the degrees of freedom, and I would liken it to this metaphor. When you're looking through a keyhole, you can only see what you can see through the keyhole. You can't see beyond the limitations of the scope, and the scope would be what you're looking for. So in this case, our limitations are a data set that goes back to July last year and extends to the present. And this is, I'm sorry, this is weeks. This is way more. This is July of 2021. Let me go back to a more ordinary chart of a daily chart. So this data set, and data set again is a fancy term meaning how much are you looking at? I like to use the photographic metaphor here, and that means you can have a wide angle lens where you look at more data in less detail, or a telephoto lens where you zoom in and see less data with more detail. And that is exactly the function of this feature. If I want to look at a 1 hour chart, I see much less data because this only goes back a week or so, but with much more detail. When I zoom out, to keep the photographic metaphor to say 4 days, I see much more data because I'm now going back to December of 2022 with much less detail. Yes, is that clear to everyone? It's an important distinction, and I want you to be aware of it. Now, all indicators, stochastic, RSI, MACD, force index, you name it, are all derivatives of these 5 data points: the open, the high, the low, the close, and the volume. Let me repeat that because I think it's important. All technical indicators, all of them, are based on some manipulation of these 5 data points: open, high, low, close, and volume. I'll show you my favorite indicator, which is called the Elder Force Index. And all this is a manipulation. It takes the difference between the highs and the lows of yesterday and today, multiplies it by volume, and gives you this oscillating indicator that oscillate. They're called oscillators, by the way, that whole class of indicators that varies above and below a center line or between a limit and a floor. Are called oscillate because they go around. Oscillate is a Greek word meaning circulate, to revolve around a zero line. So what I know from this is that when it's below zero, the tendency is for a downward trend. And you can see this. And this is another thing I want the newbies particularly to be aware of. Oh, thank you for responding, Gidon. I appreciate that. We are uniquely gifted as creatures in the area of pattern recognition. We have evolved to be able to recognize patterns. If we're cowering underneath some cover to avoid predation, or we're looking for an objective and we're trying to keep low and we can only see a little bit, we can see a shadow, and so that we can capture prey to eat. We're pattern recognizers. And I'll tell you something else. It's well known in certain, in the neuroscience world, that infants, average intelligent infants, can recognize at 1 year old the difference between a friend or a foe. And they do this by recognizing patterns in the face and nose relationships and eye. I don't know how they do it, but it's well known that they can do it. Now, if an infant has that innate ability, reading charts is trivial for us. Trivial. And my point is, all these indicators do is help us recognize the relationship between these candlesticks and these bars. Pattern recognition. If you can see these relationships with your naked eye, you don't need any indicators. Your mind is making the pattern recognition relationship. I hope that's clear. So, what I like to do, so this one indicator I use, it's just a combination of volume and price. We can see that when volume and price are on the move, the indicator really spikes up. And at these kinds of points here, we see that this is likely a reversal point. Again, did you need the indicator to know? Well, you only know it because of the data to the right. We live on the right edge of the chart. There is no data to the right. We live here. So these indicators can give us a sense of what might happen in the future, but it's far from guaranteed, I assure you. You've got to, contrary to the many warnings you see on these sites, that past does not indicate the future. That's nonsense. The past is the only indicator of the future we have. And it definitely does indicate. Is it 100%? No. There's no 100% in this business. Anybody who tells you otherwise is lying to you. So, indicators manipulate these 5 data points. So here is an indicator called the Elder Force Index, which combines that for you. Another indicator I'm very fond of is the moving average. Now, these moving averages are classic tools. And I'm going to explain something about the moving average that may come as a surprise, that may not. Moving average is the average, the mean. It's a simple mathematical device we all learned in grade school. You take the sum of the data points, in this case, all of these, and you divide them by the number of data points. That's the mathematical mean. That's all there is to that. Now, the moving average says every time a new data point enters this data set, meaning the next bar, drop the previous. So if it's 20 days and you've just added a 21st data point, drop the 20, the first one. So that goes from 21 back to 20. And that's the moving average part of it. And we can you can choose, and you can see here. Oh, by the way, let me say, we're using TradingView here. TradingView is the Rolls-Royce of online graphics systems. There's no better. I have a paid account only for the purpose of availing myself of a couple of indicators that don't come on the free account. The free account is more than adequate for serious traders. It's very flexible. I'm not going to go into a session about how to manipulate it now, but suffice to say, it's deeply rich in very useful features that are easy to access and manipulate. And I'll leave it at that. Now, with the moving average, I'm able to see price over time. I'm going to give you a little quote from one of my favorite Oscar Wilde books called Lady Windermere's Fan. Oscar Wilde was a genius, by the way, a very sharp-witted and sharp-tongued comic genius, a tortured character, by the way. In that story, Lord Darlington explains to Lady Windermere that a cynic is somebody who knows the price of everything and the value of nothing. He knows the price of everything and the value of nothing. So I know at this price, let's take the last price of crude oil. It changed hands at $77.10 a barrel. It's not enough information to know the value. Did the buyer get a bargain? Was the seller taken advantage of? Did the buyer overpay? We don't know the answer to those questions unless we know the value of the asset. And value is simply price over time. So in the pink version, that's 20 days. Oh, this is a 4-day chart. I'll go to a 1-day chart simply to make the mathematics more explicable. The 20-day chart shows me that this is what the market valued this asset for the last 20 days, which not remarkably, I should say, is approximately equal to the 50-day moving average, but well below the 200-day moving average. Why, you ask, those particular metrics? Well, 20 days is about a month of trading, assuming 5 days a week per month is 20. The 50-day is approximately a quarter of a year, and the 200-day is approximately 1 year. And so from these moving averages, we know whether the market is pricing the asset above what it previously valued it at or below what it previously valued it at. And I say above for the last 20, the last 50, or the last 200 intervals that I choose right here. And let me tell you something else about these technical indicators. One of their wonderful features mathematically is that they're applicable through all time horizons. So you saw that I clicked from 4-day to 1 day, I got my averages. If I go down to 1 hour, the averages still appear and possess the same statistical significance. On the 1 hour chart, I've got a nice upward moving trend, right? It's currently above all the moving averages. That's a healthy sign. Now, if I wanted to trade oil, I would verify this by looking at this is a 1 hour chart. I'd like to look at a 15-minute chart. Is this trend still in train in 15 minutes? No, it's not. We see that the last, we'll call it 2 hours, 2.5 hours, it's not above. It's falling. So the 15-minute chart does not verify the 1 hour chart. The 4 hour chart certainly does. So in the 4 hour, I've got a healthy uptrend. On the 1 hour, I have a healthy uptrend. On the 15-minute, not so much. Now, the question of whether you take two time frames as valid verification or not is a personal question. And let me say this, particularly again to the newbies and their relationships to these indicators and these charts. Particularly for the uninitiated, there's the sense that professionals have the secret indicators and they have the secret information, and these people know how to make money, where I, as an ordinary mortal, keep losing my money. That's not reality, all right? I've been trading, as I mentioned earlier, for decades upon decades. I've lost tons of money. I've made tons of money. The sine qua non and success of our business is making more money taking more money out of the markets than you put in. For put in, you surely will. Anybody who tells you that they can succeed at this business without losing is full of shit. It's not possible. Just like in any other endeavor, you need to be able to know how to lose in order to win. In no endeavor is there a success that hasn't failed. What do they call a medical office? They call it a medical practice. It says so right in the door, medical practice, so-and-so MD. They're practicing. Sometimes they don't do so well. No athlete, no successful athlete hasn't lost. But what's the difference between those who are successful in this business and those who aren't? They don't suffer absolute losses. And I might say this applies also to those other worlds. They learn from the failures. They learn from the mistakes. In trading, they understand what got them into the trade. Why did they get out when they did? Excuse me. Was there a mistake in those calculations? So the relationship to this data and your trading is highly personal. I might say, well, looks healthy to me on the 1 hour. It's certainly healthy on the 4 hour. I'm going to get into a trade for 90 minutes, and I think I'm going to do okay. Highly personal. That might not suit you. You might want to see confirmation on 4 charts. Highly personal, and you've got to respect your own emotionality. I'll tell you why. Well, I won't tell you why. We're only here for technical trading. I'm not going to go into the psychology of things today. We're going to leave that for another time. So here are our moving averages. All right? Does everybody understand this idea of value versus price? And finally, I'm going to show you the last indicator that I prefer is what we call volume on price. All this indicator, again, it gives it that NASA Cosmodrome feel to it. Don't be intimidated by this stuff, ladies and gentlemen. All these data points are, and all these fancy ass graphs are graphs of human emotion as they are attached to a particular asset. It ain't science, it ain't engineering. This is a probabilistic world you're looking at. These indicators are probabilistic. And what does that mean? In the world of NASA, in the Cosmodrome in Kazakhstan, etc., they live in a deterministic world. That means that what they have discovered, what we've discovered as a civilization, can be relied on time and time again to produce the same results. So using this deterministic scientific information, we can construct buildings, we can construct cities, engineering projects, entire civilizations, because we know that what we know is reliable and going to be true in all cases. Cute, right? Don't be misled. This is not a deterministic world, ladies and gentlemen. We live in a probabilistic world. Yes, economics loves and has traditionally represented itself using the clothing and the garb of science. They use Greek letters and they use scientific formulas and calculations to indicate things. But excuse me, ladies, for that. But it ain't. This is probabilistic. And let me explain exactly what I mean by that. This means that let's take the case of the non-farm payroll report, a well-known phenomena that we monitor every month. We know that 8 out of 10 times the response, the reaction of the trading community to the results are going to be according to the textbook. And again, standing on one leg, it's like this. If the report comes out better or equal to or better than the expectation, it's likely that the US dollar is going to strengthen. And I'll show you that, in fact, that's exactly what it did. I'll take these charts back to, I guess, 4 hours now, and you'll see that immediately you're able to see where the NFP was. Okay, they work out reliably, but not all the time. And that's the difference. All right, these charts do not work out all the time because we don't know of the 8 out of 10 times which one this particular episode is going to be. So here you can see, here's the NFP. There's the NFP. Here's the NFP. Is this clear? These had clear, and you can even see where we had trades. We made money on the dollar yen. We made money 2 Fridays ago on the dollar CAD. But they're probabilistic. We don't risk, by the way, is simply defined as the probability of the unexpected occurring, and occur it does, plenty. You got to understand that all these charts and graphs are not deterministic; they're probabilistic. So, getting back to where I was saying about what this indicator is, this indicator restacks the volume that's displayed on time to the volume, the total volume in the data set, to price. So if I take a fatter data set, it goes back to October of 2024, 23. This is October of 2023 here, right? This is about a year and a half or so. I see that most of the price activity in this chart took place right here. And to further confuse you, I shouldn't say confuse you, I don't want to confuse you. The colors here indicate the following. The deeper colors are 2 standard deviations of data. That means that 97% fall within this space. These, and you don't see it on this side because there's not much of a tail. This shows approximately a percentage and a half of the data set, and here this little guy shows us the other percentage and a half. So 97 plus 3, 1/2, and 1.5, and 1.5 is 100% of the data is represented in this histogram, or what we call profile. And this profiles the volume in all of this data and at what price it was traded at. Is that clear, ladies and gentlemen? This is an important indicator for my sensibilities. You're going to have to find indicators for your own sensibilities. And maybe I'll start to wind down and end on this point. There's another confusion that many of new people suffer with, that there are certain indicators that are ironclad, that are written in stone, that every trader worth her salt uses and relies on. No such thing. This is another myth. As I said earlier, the less indicators, the better. And I don't think I finished clarifying that point, so I want to make that point again. The more indicators you have, the narrower your viewing window becomes. And the narrower your window becomes, the less trades you're going to have available to trade. I can design a system for you in 5 minutes that it will guarantee every trade make money. The problem is you'll starve to death waiting for that trade to show up. That's not a system. System that has all the indicators, and when it happens, I'll make a fortune. Yeah, but it's not going to come up on your screen too much because you've limited your degrees of freedom to a point that all those conditions are never going to be met. You want a system where there are enough conditions that give you an indicator, looks good, but you could be wrong because there's risk. And risk is the probability of the unexpected occurring, and it occurs. But you want a system that gives you enough indicators that says, here's a possibility to make some money. That's all you can hope for. And so please don't be misled into thinking that there's some secret sauce that the pros use. Now, what the pros have accumulated is the ability to control their own emotions when they're in these trades. They set their stop losses, and we'll have sessions on these subjects as time unwinds. But when they get into a position and immediately turns to a loss, the pro says, okay, here's the amount of loss I'm prepared to absorb before I get the hell out. Because this is what I expected it to do. It's not doing what it expected to do. I'm not going to let my losses run like an amateur and pray to God that I'll finally be redeemed because of a reversal. No, that's what the amateurs or the rookies do. They always lose. The professional says, that's it. I've seen enough. I get the idea. Not for me. I was wrong. My ego is not so sensitive that I can't admit a mistake. I admit it. I was wrong, whatever. People whose egos are a little bit more constrictive will say, no, I know I'm right. I just have to wait. The market's I'm ahead of the market. You get the idea where that's going. And the flip side, I would say even more the evil twin of that sensibility of fear. I can't get out of the trade. I know I'm right because if I get out of the trade, I guarantee my loss. It's better to hope that it'll work out than actually take the loss. Its evil twin is greed. You get into the trade, and within seconds, you're in the green. You're profitable. Again, what does the professional say? I had no sign that I'm any kind of genius. I didn't figure anything out. I took my position. I made my money. I get the hell out. I'm not going to stay for more and more and more and more profit because what happens? These people get crushed. I have often likened this business to bending down, picking up nickels in front of a steamroller. Stay too long, you're going to get crushed. Take your money and get the hell out, whether it's a win or a loss. So I think that's about it. Let me just show you one indicator which I use sparingly. This is called the Commitment of Traders Report. This is only applicable to commodities traded in Chicago. This statistic is created by the Commodities Futures Trading Commission in the United States, and it shows the net positions for large speculators, small speculators, and commercial hedgers. And all this tells us is that, well, it tells us several things. The green, the small speculators, we never follow these people. These are small traders. They're always wrong. We don't care about them. The blue are commercial hedgers, and they're more than likely to be opposite the trend because if the price is up, they're selling. They're short. They're not interested in profiting. They're interested in limiting their costs or their risks. So therefore, by process of elimination, these people, the large speculators, are often, although mistakenly characterized as the smart money. But in this case, they are. In this case, they're net long and oil is rising. Another a further indicator, but keep in mind that is a rare beast. It's a queer animal. The commitment of traders reports. It's only applicable to commodities traded out of Chicago. So, ladies and gentlemen, with that, I would like to wind this down. This is about the amount of time I find optimal for these sessions. But let's open the floor to questions. Gidon asks, please again explain the relevance of volume on price. Surely, sir. Volume on time, you understand, right? All this is the volume that occurs during the interval. So we see on this interval is a big price bar and a huge volume bar. That means there was a lot of sentiment behind that downward move. In fact, the bars are colored to represent the majority buyers or sellers. In the case where the bar is colored red, there were more sellers than buyers, and not surprisingly, in this case, the price declines. Not always so. Here's a massive way above average volume bar, and the volume the price barely moved. That's a classic case. There was a battle, a powerful battle between the buyers and the sellers, and it resulted in practically no price movement. And even though that the net volume was selling, price barely moved. These are indicators, ladies and gentlemen. They just indicate. And let me just say another word about indications and indicators. Think of indicators as being your dashboard panel of lamps and lights and idiot lights. You can't pilot your vessel, whether it's an aviation vessel, a marine vessel, or a road vessel, looking at the indicators. You'll kill yourself. You'll drive into a tree. You have to glance down at the oil pressure to make sure the coolant temperature is normal, make sure your RPMs aren't revving out. But you got to look through the windshield. This is the windshield, okay? These are the indicators. You know, you glance down at them. Don't take trades based on these indicators. In my opinion, that's my opinion. Take trades based on your sense of the fundamentals, the technicals, and I didn't even mention the fundamentals, and I will now just briefly. But Gidon, did I clearly explain the relation? I didn't. Volume on price. I didn't even get to the question. So this is volume on time, right? In this case, 4 hours. This is how much trading occurred in these 4 hours. This is volume, all these trades here, all these days here, on price. Most of the volume took place here at 73.85. That tells me that the majority of trading took place right here. So in this data set, we're fairly well balanced. And you can see that from the profile. Once again, these indicators are generally not showing you anything you can't divine with your own eyesight. But I like volume on price because it tells me whether we're above value, at value, or below value in the data set that we're looking at. Have I answered your question, Gideon? And furthermore, are there any other questions, ladies and gentlemen? My pleasure, sir. If there are no other questions, let me make you aware that our next session is tomorrow. We're going to have a live trading event on the crude oil inventory report. And this is really, in my opinion, one of the only two events on the economic calendar that are actually tradable. The NFP, of course, which is the granddaddy of them all, and the crude oil inventory report. And we'll go into detail tomorrow what that is. But it's, again, these live trading events are often a great deal of fun. They're exciting. We can often have a chance to make a few dollars, but they're always well worth the experience because you don't have to know anything. You don't have to guess. You don't have to predict. You just show up and wait. And I'll show you what the setup is and how to proceed after we see the results. So, ladies and gentlemen, if there are no further questions, and I see there are not, let me say on behalf of the staff and the management here at Bankso that we're always humbled and grateful to you for your patronage of the firm as your online banker, online broker. We do our best for you. I hope this session is an example to you of the kind of effort we put in. We don't always win, okay? We lose plenty like everybody else, but we do make more than we lose in the long run, and that, as I say, is the sine qua non of success in this business. My pleasure, Gideon. Thank you very much for your participation. I appreciate the compliment. And so, ladies and gentlemen, I'm your host, Seth Julian, wishing you all, ladies and gentlemen, the ability to trade with confidence. Bye bye for now.